Thank you, everybody, for joining. As usual, appreciate those that join these daily conversations, whether it's on Twitter, LinkedIn, or other platforms where this streams. I'm excited for this conversation with Mark Spiegel. I'm sure a lot of you have seen some of his work and some of his criticisms around Musk, which we'll talk on. With all that said, my name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Mr. Mark Spiegel. Mark, for those who are not familiar with you, introduce yourself. Who are you? How'd you get interested in markets? And what are you doing now?
Sure. So I run a small, long-short, value-oriented hedge fund called Stanfill Capital. That's Stanphyl. I opened the fund in 2011. Before that, I spent, I guess, about 8 years, most of 8 years, as an investment banker on the sell side. Before that, I had a completely different career. I spent 17 years out of college in the commercial real estate industry. So I didn't actually come to Wall Street until I was like 40 years old, or 42 maybe, I guess. So very varied background, and that's the story. So we do in this fund, we do both individual companies and macro stuff, just depending on where I think the markets are. I mean, if stocks are cheap, I'd much rather own a bunch of cheap micro cap value stocks. That they just haven't been cheap for a long time. So we've almost sort of been forced into the macro, because if I think things are expensive, that's a good way to express that thought.
So I always say there are no gurus, only cycles. And you started in 2011. Let's face it, the value cycle hasn't exactly been favorable, right? Especially, I'd argue, since QE3, post 2012. How have you managed through an environment that doesn't really favor the style, you can argue, because it's really been largely dominated, as we know, by just a few large cap, mega cap growth names?
That's an excellent question. So I should say, by the way, that even while I was an investment banker, within those restrictions, which if you've ever been a banker, they're kind of nasty. Like, you got to get compliance permission to buy or sell anything. There's a mandatory hold period, which could stretch into weeks. But I did put together that performance. That was from 2005 through 11. And I had that audited, and I used that for sort of some basic marketing when I opened this fund in 2011. So I've seen a number of cycles. I mean, I was actually up during the 2008 crash, but of course that might be consistent with what you're saying. I mean, we happen to be up a ton this year, although we had some down years during this bubble for sure. Really, the down years were entirely Tesla, because we've been short a lot of Tesla really since 2014, and it went 20x on us, and it was a hell of a fluke. But to answer your question, even through the bubble, if I eliminated Tesla from the performance equation, and it was really a fluke, we would have still been up all those years, and probably matched or outperformed the S&P, even though we're value investors, because I always manage to find a few really cheap sort of nano cap, micro cap stocks every year, and have had very good success with them. I mean, even in a bubble market, there are companies that nobody cares about. And so that's the kind of stuff I like to buy. And to be clear, these are not, on the come story stocks. I just buy companies that are selling at an enterprise value that's a small fraction of revenue. And then that aren't losing too much money. They're breaking even. They're making a little. They're losing a little. Those are what I call call option stocks. In that, they may sit there. I mean, I've sometimes have had to hold one of these stocks for 3 or 4 years. But if you're buying it cheaply enough on a revenue basis, some strategic acquirer can always come in and basically fire the C-suite and eliminate the cost of being a standalone public company, and it becomes instantly profitable. And if the average company is selling at, I don't know, well, it got to 2 times revenue in this market, right, or higher, depending on the sector. But let's say your business is selling at 1.5 times revenue, and you can buy this little company at 20 or 30 or 50 or 60% of revenue. It's very revenue accretive, and it becomes profit accretive if you can cut costs. So that was traditionally always the bread and butter way that I made money, except that, when things got crazy, I would start doing more macro stuff. So, we're up, as I said, we're up a lot this year, and it's our best year ever. And our second best year, we were up over 50% net. So that gives you some idea of how we're doing, at least, with 2 weeks left in the year. You never know. There's always some way to get fucked up, or, but at any rate, and that's a combination of being short Tesla, which, after costing us a lot of money, has now made us real money, and being on and off short the S&P. I mean, I've tried to trade that basically based on sort of sentiment cycles over multi-week, a multi-week basis. I mean, when it just got really oversold, I covered it and I reshorted it. And some of these trades I wind up actually putting on Twitter. And, sometimes I was thinking about this today. I mean, I am not a short-term trader. I am definitely not a day trader. I mean, never in a million years do I think about going home flat at night or whatever. But it can sort of look that way somewhat on some of my recent SPY trades because, I've had this core short position, and we can get into why. But then I really want to get heavy when I think, the market is the bear cycle is about to resume. And so I'll kind of pick either a sentiment level or maybe a strategic level on the chart. I mean, I look at charts for entry and exit points around fundamental positions. That's how I use TA, just to sort of pick where to get in and out a little bit. And so, sometimes something will fluctuate. I mean, just as an example, it wasn't really what I was using, but, S&P broke back above the 200-day moving average, I'd cover it, and it would cost me a few bucks a share, SPY. And then it broke back below, and I would put it on. I'm happy to take these. I'm not happy, but I'm willing to take these sort of small whipsaws so that I'm locked in place for when the large fundamental trend that I'm looking for, gets going. And as far as the S&P goes, look, I saw you put out a terrific, just this morning, 20-part thread, about why the conditions could be right for a market crash. And, you clearly weren't predicting one. But, I mean, to be clear from where I'm coming, I don't know if the market's going to crash or grind down or what, but here's what I know, like really, really simply. The largest asset bubble ever was blown thanks to 0% interest rates worldwide, and in the US, 120 billion a month of QE, and in Europe, tens of billion a month in QE, and even QE in China at some point. I know that asset bubble can absolutely not sustain 4.5% interest rates and 90 billion a month of QT in the US, and Europe going to be doing tens of billions in QT starting middle of next year. I mean, it's inevitably gonna pop. I mean, the conditions that made it, when they're reversed, it's gonna pop, and anything else is just, I don't want to say noise, but it's almost like too much data. You don't need it. Does that make sense?
Yeah, no, and actually, there's a lot there I want to unpack, because I think that it's interesting, right? Because you alluded on something which every trader, every professional will go through, which is that they have a thesis and they get whipsawed until the thesis plays out, right? Almost like death by a thousand cuts. You try to short the market goes higher, but you know that no matter what, it's likely going to play out in the way that you hope, and not necessarily on your time frame, right? And that's always the tricky part of this. Now, you talk about macro and being long short. Talk about how you think through your gross and net allocations, because a lot of people hear that term long short, but they don't necessarily peel down a little bit further to sort of understand what's really the bigger driver, which is how much is long and how much is short. Okay, so I very rarely think in those terms, although that said, I am thinking in those terms now. Normally, my normal sort of rule of thumb is each position has to live and die on its own, and I will not get long something I don't love just as a hedge. And I will not get short something I don't think is worth a hell of a lot less, just as a hedge. But in this case, let's call it my core SPY short position has been roughly the size of my long positions, all lumped together. Okay. So, if 35% of AUM was long, let's call my core SPY short position, 35% of AUM to kind of balance it.
And that's kind of how I've tried to keep it when I didn't want to just get really super damn short. But, last week, I got really super damn short, and then, on off a little bit of sort of, let's call those extra shares, and then just locked them in on during the Fed meeting. I basically had a sell stop set up at that day's opening price. I mean, that's where a chart is handy. And when it plunged through there, automatically, I basically doubled the size of roughly doubled the size of the SPY short. So it just so happens now that, ballpark, maybe, I don't know, 35% of the fund long, and then 70%, SPY short. So basically twice the size of the longs. Completely separate from that is a large Tesla short position, which I'm not including in that sort of, net long, net short calculation, just because I know where that thing's going. Let me talk about Tesla for 1 second, and then we can go back to the macro, but this ties into the macro. Because a lot of people, we got killed in Tesla on the way up. And a lot of people have said, well, what did you learn from that? Did you take a lesson from that? And, for a long time, I was saying, no, you can't take a lesson from that because it was a 1 in 10,000 stock, right? I mean, how many CEOs can tweet a fake buyout of their company and not get fired, right? How many CEOs can have a demonstration of fake solar tiles and not get fired or thrown out by the SEC, right? How many CEOs can post a fake self-driving video on the website in 2016 and still have it up there and still be in their job? And if you said, well, there's lessons from that, basically you would never short anything, right? Because, I mean, if you have a checklist of things of red flags to decide, well, should I short this or not? I mean, Tesla checked every single box there is, and it invented 100 new boxes. But that said, here's what I learned. When the Fed is doing QE, quantitative easing, just do not fucking short anything. And I'm not the only guy who learned that. I mean, I've got a friend who's an MD PhD, who's a brilliant biotech short seller. I mean, he will go long stuff. He's got a very heavy short bias. And, he would short basically around events like clinical trial. They're going to announce data sometime this month, and I know it's going to miss, and he'll load up on the short. So normally in the old days, that would happen, especially a small cap biotech, misses with its main drug, stock is down 90%, right? I mean, you've seen that, right? When QE was going on, maybe it would go down 20% and then reverse and close green. So he's sort of in the same camp. If the Fed's doing QE, just don't short anything, find some stuff that's cheap. Look, even if it's not going to do a 10x, if it's cheap, eventually it gets pulled along with the tide and it'll do a 1.5 or a 2x. And, that's what I'll do next time we go through a QE cycle, if I'm lucky enough to live long enough, or maybe unlucky enough to live long enough, because I fucking hate QE cycles. Does that answer your question? It was a long-winded answer.
Yeah, no. And actually, I want to, let's keep going on that point around Musk. So I've always been of the mindset that when Steve Jobs passed, the media needed a new person to latch onto, right? Some visionary, and that's, if you kind of notice, that's when Musk's name started getting out there more and more. I'm just curious if you've done any sort of historical work on what happens to those that are gurus and seen as sort of anything they touch turns to gold, if that ends up being almost the inevitable sign that something bad's going to come in the future, because we've seen these things, I think, play out before.
Well, let's not put Steve Jobs and Musk in the same category, and I'll tell you why. Yes, Steve Jobs could certainly, from everything I've read, be an abusive, jerk to work for. There's no question about that. So they have that in common. But Steve Jobs was a brilliant business guy. Steve Jobs went and negotiated awesome deals for his iPod with the record companies, right? I mean, Steve Jobs put together awesome deals, I think, when he founded, Pixar, right? And was involved there and sold it. I don't know. The point is, Jobs was a brilliant business guy. Musk is a fucking business moron. He's just a great stock promoter. And by the way, as far as I know, Steve Jobs never, frauded up his financials, right? I think there was one time when he did some bullshit on repricing his options or something. But overall, Jobs was smart enough to not take shortcuts. Musk is the most incredible stock promoter and fundraiser I think we can all agree that anybody has ever seen. And the way he does it is amazing. You know, the way he promotes stocks, because he's a mumbler, right? He's not smooth, but that's obviously part of his shtick. I mean, on Saturday Night Live, he said he blamed his whole thing. He said he had Asperger's syndrome. Now, I immediately started making fun of him after that on Twitter and started calling him Mr. Fraudsburgers. I said he doesn't have Asperger's, he's got Fraudsburgers syndrome. And why did I do that? Not to make fun of people with Asperger's, for God's sake, but he's just a fucking liar. There's nobody with Asperger's syndrome can consistently look people in the eye and lie to them, right? The thing about Asperger's syndrome is, among other things, you know, you're honest to a fault. You're blunt spoken, you know, and you don't necessarily have a great ability to make eye contact. You know, you look at the interviews with Musk, he's looking people right in the eye and lying to them. So that's just more bullshit from him. But anyway, so to your point, your original question, I just want to exclude your point, by the way, about the media needing a hero when Jobs died. That's very interesting, and that's a very plausible explanation for what happened here. But people like Musk always blow themselves up in the end. I mean, you know, Donald Trump and Musk are two sides of the exact same coin. They're both narcissistic, you know, grifting personalities. And by the way, as people who follow me on Twitter know, I'm no Democrat and I'm no lib, but I can certainly see Trump for what he is. And you know, Trump is now finally blowing himself up. Sometimes it can take a long time. Sometimes they're Teflon for a long time, you know. So what's happening to Musk doesn't surprise me at all. And for years, I've said I knew it would happen. It's just obviously the timing was tough. I mean, this story, I mean, look at the complete regulatory breakdown around this guy, right? I mean, that fucking moron of an SEC chair, Jay Clayton, could have shut this whole thing down when Tesla had what, a $50 or $60 billion market cap, when Musk did the fake 420 tweet. But Clayton's thing was he put out he actually wrote a letter saying, I'm paraphrasing, I decided to just give him this wrist slap, the $20 million fine and 20 mil for the company, because I know there's a lot of retail shareholders here and I want to protect them and not crush the stock. Well, what happened after that? After that moron did that? Well, the stock went up another 20x or whatever, right? And now you're seeing what crushing retail shareholders is like, to the tune of hundreds of billions of dollars instead of tens of billions. And then there were all these copycat fraudsters, like the guy, you know, who pushed the truck down the hill, right? And well, Holmes was really concurrent with Musk. But the point is, Clayton, you know, a lot of this I pin on Clayton letting Musk get away with it far longer than in normal circumstances Musk would have been able to get away with it. But eventually, you know, they write their own downfall. Look, I'm not a psychiatrist, but clearly what's going on here with Musk is a guy who on some level feels that he deserves to destroy himself, right? And I mean, okay, that's dime store psychology, but it sure seems to be what's going on, and he's finally doing it.
Yeah, and I mean, I'll tell you, that's always been a worry of mine. You know, in my case, I use Twitter for a lot of business, right? And it's like when you have all your social media credibility in one basket, in the Twitter basket, right? It becomes a whole different calculation when you have a volatile personality that's not exactly a beneficial dictator, right? In the way that he's approaching the land, so to speak. But so let's talk about the Tesla movement this year, because it's been, you know, I mean, kudos to you for having a comeback given the way Tesla's short has played out. Presumably, there's going to be a point where you would totally change your thesis or say, okay, now enough is enough. What would be some of the markers for you for when to lighten up on that short?
On Tesla? Mm-hmm. Well, okay, so Tesla is thanks to some heavy discounting this quarter, you know, they'll probably sell around 400,000 cars this quarter. So that would put them on call it a 1.6 million annual run rate. BMW sells around 2 million cars a year with very good margins. Okay. sort of I don't know if they're right, my bogey, my whatever, my measuring stick for Tesla, and I've said this for years, it just happened a lot faster than I thought it would. I said, best case possible, Tesla gets to be about the size of BMW and valued about like BMW. So BMW has a market cap now of, I think, about 60 billion. Hold on one second. Let me look it up live. Hang on. Yeah, roughly 60 billion US dollars. Okay. Tesla has over 3 billion shares outstanding, roughly 3.15 billion. If Tesla were valued the way BMW is, it would sell for around $18 or $19 a share. So, and by the way, that's only if the Tesla financials were legit, which I think they're not. And also Tesla has, massive multi-billion-dollar liabilities out there that BMW doesn't, in terms of this whole full self-driving scam. Not just the lawsuits for people killed, but how about lawsuits for billions and billions of dollars from people who want refunds because it's a nonsense product, and not just the people who spend $10,000 or $12,000 or $15,000 for it. How about people who bought the whole $70,000 car because they were told it would be able to drive itself by the end of the year, right? So there's big liabilities. But I guess my point is, my current plan is to cover Tesla like in the high teens, because that's sort of the best case scenario. And I'm not going to short something hoping the best case scenario doesn't play out. That's kind of my margin for error on a short position. I short it, I cover when it gets down to the price of the if everything goes right situation.
Yeah, and I'm curious, do you think that would maybe on the way to that sort of mark a broader bottom for the stock market, right? If you take out sort of the poster child of the bull market and bring that down to earth, would that be a sign that the water's safe for a broader, longer term bull thesis?
I think Tesla can completely decouple and non-correlate with the overall market at some point, and maybe that point is now, because the Musk magic is gone. The inventory is piling up. I mean, you can look. They have all kinds of inventory in China, in the US, and now apparently in Europe, at least in the UK, they're loaded with inventory. They just cut prices this morning in the UK. In a bull market, there were always, some bear stocks, and in a bear market, there were always some bull stocks. Regardless of whether the bear market continues, bottoms or not, I think Tesla could, wind up down there no matter what happens, And by the way, just to take one step back, because you asked about the broad market. So what I'm looking at right now, look, I mean, if you take Q3 GAAP S&P earnings and annualize them, okay, and that's somewhere in the 170s, and put a 16 multiple on that, which I think is actually pretty damn generous for a rising interest rate recessionary environment. Or even say, let's say the Fed stops raising rates at 475 or whatever, it's, in a recession, a 16 multiple on what were non-recessionary earnings. I mean, for Q3 earnings were the 6th highest in history, S&P earnings. A 16 multiple on that puts the S&P down in like the 2800s. So right now, my sort of working scenario, obviously always subject to change as things change, is the S&P bottoming out, generously, I should say, bottoming out, because it could easily overshoot a 16x and be at 15 or 14 or 13x, right? But my plan now is to cover my S&P short, or my SPY short, somewhere where the S&P is in the 2800s, mid to high 2800s maybe. And I'm looking for that sometime over like the next 6 months, 6 to 8 months, by the fall of 23, maybe sooner. Everything seems to happen more quickly these days, right? There's just so much more data flowing so much faster. That's what I'm looking for. So going back to the very, very beginning of this discussion, I don't know if it's going to crash down to there, this afternoon, or the third week of January. I wouldn't even start to try to predict that, right? But I do think that that's where it's heading, and if it gets there, based on what I know now, I'd probably cover the shorts, I wouldn't get long because it wouldn't be cheap there. It would be sort of maybe fair value-ish there. I mean, I'm saying I wouldn't get long the index. And then I would step away from the macro and, hopefully by then there'll be some oversold individual stocks I can buy. I mean, we own some stuff now. I mean, we own the auto OEMs, several of them, because I'm buying them at in case of Stellantis, like 3 times earnings up to, call it 6 times earnings for GM. And we also own Volkswagen at like 4 times earnings. But some of these are also asset plays. I mean, Volkswagen, hell, Audi alone is worth more than Volkswagen X the Porsche ownership, right? So, I mean, it's crazy, these numbers. And I think a lot of what happened to the autos was, and the reason they're holding up okay lately, certainly way outperforming Tesla, is a lot of money came out of the autos because there were a lot of idiots who were like, oh, Tesla's going to take over the auto world, and those old school engineering idiots at Porsche, they'll never be able to design an electric car. And so there was a big valuation penalty in the OEMs. Of course, what I used to tell people, and for years they wouldn't listen, is you can't tell me on the one hand that the brilliance of an electric car is it's so simple and it's only got 15 moving parts or whatever that douchebag Ron Barron used to say on CNBC all the time. And on the other hand, you're going to tell me that the engineers who design modern internal combustion engines, which rev to 7,000 RPM, right, last 300,000 miles and create almost breathable emissions, right, and have a lot of parts. You're going to tell me those guys can't design an electric car once they put their minds to it, and once their bosses say, "Hey, the market is here," or the government's forcing us to build electric cars, and we got to sell them. Guys, go ahead, design an electric car. Well, obviously they could. This was obvious to me back in 2014. I mean, I can't believe this took so long, but those cars are here. I mean, you can buy from almost any OEM, you can buy a better electric car in almost any automotive price category than the comparable Tesla. And part of that is because, Tesla, I'm sure, has good engineers too, but Musk has starved, relatively speaking, the company of R&D in order to show these sort of skimpy profits, which enabled the stock, which was one of the reasons the stock went 20x. The other reason, of course, were the inexplicable call option gamma squeezes. And maybe one day we'll find out that somebody with the initials EM was behind those. It would not shock me from some offshore account. I mean, it would be a brilliantly illegal thing to do. But anyway, that was just another reason why Tesla went up. But I think that money is flowing back. Oh, so I said he really didn't spend enough on R&D. I mean, their whole model line is aging badly now, and there's a lot of better stuff out there. But he was able to show these skimpy profits and say, see, Tesla's profitable. The stock went way up. And on paper, he made himself whatever, $200 billion. Of course, that's rapidly evaporating. And the other interesting thing, of course, is you see that in order to realize that paper net worth, it's impossible because you see how little real fundamental investing there is in Tesla and how it's probably mostly machines flipping it back and forth because Musk sells a relatively small amount of stock and the price tanks 10%. When a real seller comes in, it can't take it. So
then so the big question then to me is, and I don't disagree. I mean, you could have a complete round trip of the post-COVID, run in the passive indices, the large cap, market cap oriented ones. I mean, you've seen that in a lot of stocks to begin with. So what's to say that it can't happen to, sort of the headline areas? But what would you think that bonds would look like at that point in time? Where would the 10-year yield be? And because that's been sort of the what I've said many times has been sort of the hell, right? That treasuries failed to act as the safe haven, all while credit spreads stayed fairly tight, all while you had the fastest rate hiking cycle in history. Do you think that means that we get back to sort of a normal environment where there's a flight to safety trade again? And if so, how does one play that?
Well, so that's a great question. And, I have opinions about that are worth exactly what I'm about to charge you for them, which is zero. Look, real question is, where's inflation going, right? Obviously, 8% was unsustainable, 7% is unsustainable, 6% is unsustainable. So where's the floor? And I'm in the camp that the floor is going to be somewhere in the 4% range, that we have new secular inflation, and the Fed's not going to be able to get it down sustainably to 2. I mean, maybe right now it's a run rate of whatever it is, 3, whatever, 2.5. But, if there's a serious recession, the political pressure is going to be on, and fiscal spending is going to happen, even if QE doesn't. And, I think it's going to quickly reignite. The reason I think it's a secular issue, really probably threefold. One is, call it the war on fossil fuels. All this nonsense that they're trying to jam people into doing with energy, with absolutely no cost benefit analysis, by the way, right? I mean, they're going to spend hundreds of billions of dollars subsidizing electric cars in this country, and you won't even be able to measure the difference it makes in world temperatures. I mean, it's just nonsense. There's just no critical thinking at all that goes on in Congress or in the religious climate lobby, right? They just, you say, well, okay, that's interesting that you want to spend, $300 billion on this. How much will it reduce temperatures? They won't answer the question. They'll just say, well, we can't just do nothing. And then I could say to them, well, how about for $300 billion, you give people a lot of free health care and an air conditioner, whatever. I'm being a little bit flip, but there are much better ways to help humanity than spend trillions of dollars trying to control the climate. We can adapt. People can adapt. If the temperatures are 2 degrees higher and beach houses get flooded, if that were to happen, we adapt. Okay, you're not going to change that by spending trillions of dollars. Instead of 2 degrees, it goes up, 1.85 degrees. Well, what did you accomplish versus what else you could have done with that money? But I got sidetracked here. Again, I'm sorry. What was the original question?
No, just how do bonds respond if you're going to have another wave?
Yeah, sorry. Yeah, right. So inflation, right. So the war on fossil fuels, and then I went off on my crazy tangent. So anyway, so here's why I think the new floor for inflation is more likely to be 4% or whatever, 3.5, 3.75, and 2. Much higher energy costs, population that is aging, and therefore, a shortage of younger workers, which we're already, starting to see now, and onshoring, right? I mean, the reason we started making stuff in China or, Vietnam or other parts of Asia, it was cheaper. That was the reason, right? If we say, well, it's strategically a risk, or if I just don't want to risk my factory, even if it's a bra factory, whatever, not a microchip factory, getting shut down or whatever, I'm going to bring it to the U.S. Okay, fine. But now it's more expensive here in the U.S. So those three factors, plus, of course, perpetual, deficit fiscal spending by the federal government here, that's going to add up, I think, to a higher, call it floor for inflation. So getting back to bonds, what happens if inflation gets down to 4% or 3.75% and kind of levels out there? What's going to happen now? So to answer your question, I mean, what should the 10-year yield over the core inflation rate? 1.5 over, something like that, at least 1 over, right? So I think bonds are going back up, but they may go down first. I don't know. I'm not being wishy-washy. I honestly just don't know. I mean, if we get this temporary lull in inflation because we get a recession and China sort of stays de facto closed because of COVID, even though the government reopened things, if you read what's going on there, people aren't leaving their apartments because COVID is raging there. So inflation can come down somewhat, but I think it's heading back up. So I guess I'm saying that long term and let's say over the next X number of years, I sort of see the 10-year in the 5% range, maybe 5.5. Not 2.5. But I'm not a bond trader. I'd rather express my thoughts about this through stocks and maybe gold, by the way. I mean, I'll say this. I mean, we do own gold in the fund. Obviously, the biggest driver of gold is real interest rates, right? So real interest rates right now are ostensibly still very negative. I mean, if you call inflation whatever, 7, 6.5, and the 10-year is yielding what, 3.5 right now. But obviously people don't think, people have more faith in the Fed about the long-term fighting of inflation right now than I do. And that's why gold has really underperformed severely. I think at some point the Fed will lose control. I think inflation will be higher. And the Fed will not clamp down on it. For one thing, federal budget deficit, national debt is so high, right? That, if they perpetually hold rates where they should be, then, how many federal programs are going to have to get canceled just to cover the interest on the debt, right? So I think we're headed for higher inflation. I don't want to sound like, Tyler at Zero Hedge, who obviously we all follow and to some extent I think we all love, the pro-Russia stuff aside. But, he said the other day, he caught it and I caught it and maybe you caught it. You probably did catch it when someone asked Powell about raising the 2% inflation target. And he said, that's absolutely not anything we're doing now. Maybe that's something, for a longer term study, but we're not doing it now. Well, obviously.
Yeah, I tweeted out when I put that tweet out, I said, that reminds me of him saying, we're not thinking about raising rates.
Exactly. So there you go. So I guess, long term, I'm actually bullish on gold. And that's why we have some, not as much as I've had in the past. And long term, I'm bearish on bonds. But that's not to say that I feel that way about them for the next, 6 to 12 months. If stocks go where I think they're going over the next, 6 to 8 months, I think gold will probably go down with them, and I think bonds will probably go up against them. Bond prices, yields going down, as stocks go down.
Yeah, and that point about the interest expense on national debt is where, to your point, it gets complicated, right? Because you can't really, realistically, they can't ever have a positive real rate, right?
I agree. Yeah, I agree. And obviously, on some level, once they think inflation is under control, they'll go back to focusing on trying to, quote unquote, inflate away the debt, right? So I agree. So, right, we've got, I don't know, maybe it's about 18% of the fund in gold, which, by the way, let me give you some perspective. So for me, an average positions, I run a concentrated fund. So on individual stocks, an average position size for me might be a 10% position. If it's like, illiquid, or if I, think it's maybe got 50% upside and not 100 or 200% upside, then I'll make something like a 5% position. And if I think something is just got like, 3x upside or whatever, I might make it a 15 or 20% position. So I take big positions. So on the macro side, I have no problem getting a lot bigger because I don't have to worry about waking up one morning and there was a fraud, right? Or waking up one morning and, they blow the earnings report, or, waking up one morning and their only factory just blew up, right? So you don't have those kind of individual risks. So I have no problem, even if I don't love gold now, I don't have any problem having whatever, say 18% of the fund in gold, because I do think eventually it's going a lot higher. And if we get to the point where stocks are really washed out and gold is really washed out, I'd probably double that position, and it's anything that isn't going to kill me on an overnight move. I don't mind having a big position.
Yeah, that makes a lot of sense. Okay, so that I feel like might be a somewhat of a good transition into what you referenced earlier, which is that you'll sometimes take on these kind of more micro cap or much smaller stocks that maybe got to distressed levels. Just talk through some of the techniques that you use to try to identify if a company is, first of all, real, if it's micro cap, because there can always be a degree of fraud there. And what are some of the things that maybe attract you the most to really kind of smaller cap type of companies?
So the reason I can play in small cap companies is because my fund is small enough to do it. Okay, I run a small fund. I don't mind telling you how big the fund is. As of now, we're just under $18 million. Okay, which is like no money at all in hedge fund land. And I'm actually a significant amount of that. And then I have I have a small number of very, very good investors. Other than the obvious, couple of friend and family stuff, they're almost all current or retired hedge fund guys themselves. So they understand what I'm doing. They've been incredibly patient through the whole Tesla thing because they all saw what I saw. And so with this kind of money, I can take a position in a company with a 30 or $35 million market cap, right? Or 50 million, whatever. A company that like a really great value investor, and there are a number of them that I admire, would look at me and go, Mark, that's a no-brainer, but I can't touch that. I'm running $3 billion or whatever the hell, right? So what I look for, I do a lot of screens, and my main screen, I said it right at the beginning, enterprise value to revenue. If I can buy a company on an EV to revenue basis that is less times its annual gross profit, I give it a really hard look. What does that mean? It means, let's say you got a company with a 30% gross margin. If I can buy that at 30% of revenue or less, I'm very interested, as long as it's breaking even, maybe losing a little, and because, as I said, it's either an acquisition target or, listen, maybe some new CEO comes in and turns the thing around. So to answer your question, I'm not buying story stocks. I don't worry about fraud because most of these companies have been around like forever and no one cares about them. Look, it can still be a fraud, but I figure if a company is just sort of breaking even, winning, making a little, losing a little, revenue's kind of flattish for year after year after year after year. I mean, that's not a fraud anyone would bother committing, right? I mean, you commit a fraud, you make some amazing numbers and make the stock go up, right? So these are like, and by the way, I always do check to see who the auditor is. Obviously, that doesn't guarantee a damn thing. I mean, at least I'll make sure that it's a PCAOB recognized, auditor that passes the reports and audits a number of public companies. Not an auditor like Madoff used. Two guys in a trailer, somewhere in upstate New York, whatever the hell that was. So, yeah. So I've never gotten burned on fraud. Now, balance sheets are really important to me, and I probably never would buy one of these companies unless it had a lot of net cash. In case it has a down year, or if it's burning a little, I want to make sure, okay, they're burning a little, but they got 10 years of cash in the bank, let's say. And in fact, the thing I'm most afraid of on these companies, and it's a red flag for me, is if they do have a great balance sheet with a lot of cash, and the CEO starts talking about, making acquisitions, right? Because the worst thing for me is a company selling at, 20% of revenue, blowing that beautiful balance sheet on something at 1 times revenue, and then it can't integrate it, and now the balance sheet's ruined, and now it's just an overpriced micro-cap company. So one of the red flags I look for in all the conference calls and the press releases, but it'd be more of a conference call thing, is, the use of the word acquisition, in a positive sense, not in a, no, we absolutely will not acquire anything, that's great. The guy says, yeah, we're always open to it. We're looking around. We'd like to get some. I'm like, okay, no, thank you. Not this company, not for me. So, if you have these sort of strict requirements that I have, you don't find many companies, even in nano cap land. So, I typically find 3 or 4 or 5 or 6, new ones a year. If I find 5 or 6, that's a really good year. If this market, I don't want to say crashes like overnight, but this market keeps grinding down the way I think it will, I might be able to find 15 or 20 in a year, which I would absolutely love. And that's what I look for in these micro cap companies.
Do you get a sense that over the last decade, the level of high quality due diligence on average has gone down? And I say that because so I used to contribute to Mark Faber of the Gloom, Boom, and Doom report. And I remember back in, 2015 or so, I had submitted a piece to him that he published that basically made the argument that America, we can do better when it comes to analysis because everybody's doing nothing but looking at charts and talking about the Fed. And fundamental analysis it was almost like a passing fad, at that time. I think you can even argue still now. Do you think that we've gotten to a point where just fundamentals will matter more, and that it's going to separate sort of the good from the great, or are we still in this, largely macro-driven environment?
Well, look, at the end of the day, if nobody cares about your stock, and it's actually, David Einhorn, who I know a little bit, not socially, but professionally, I know him, and admire enormously. He did a talk about this not that long ago about how hard value investing is now, because, if you find a cheap company but nobody else cares, it's going to be cheap forever. But my answer to that is twofold. A, a strategic buyer comes along, someone with a hotter stock, let's call it. Or B, at the end of the day, a company can always pay a dividend, right? So, and then dividends attract people. I'm not worried about lack of fundamental analysis. I mean, to answer your question, it's obviously in a bubble, there's no fundamental analysis at all. Look, you can define that a lot of ways. I mean, traditionally, fundamental analysis is the balance sheet and the cash flow statement. But, you have a Cathie Wood who built this fund where everything was a story stock and there were no fundamentals to look at. Well, that's what happens in bull and bubble markets. By the way, that was a great short for us. I mean, even though Tesla actually, I think, was up a lot in last year in 2021, my fund was still up a lot because Cathie Wood was such a great short for us and right into this year. And I still covered that twice as high as it wound up going. To me, it was, and it's another interesting lesson. So normally on a short position, I mean, Tesla excluded, but normally on a short position, it would be extremely rare for me to put more than 5 or 10% of the fund in it. But to me, Wood was just like one-stop shopping for complete garbage. So I think I had, pretty close to the top of her fund. I put in like 60% of the fund because I really looked at it. I think she had, 45 positions or something. So I looked at it as like, 45 different 1.5% positions. And so I was very comfortable doing that at that point. But so, you could, if you're a growth investor that's just buying stories, then fundamentals aren't going to matter to you. And then, of course, you get higher rates and the Fed starts QT versus QE. And yeah, I mean, to answer your question, fundamentals all of a sudden do matter. But I guess my point is you can define fundamentals a lot of different ways. I mean, if somebody thought this company had all these patents on this amazing new technology and it was going to be huge, that's a fundamental thing, is to get some scientists and study the technology, even if there are no financials yet to talk about. So, and look, I respect for that. That's what a venture capitalist does. And in some cases, it's public venture capital, right? If it's a public company, that's just not what I do, because, we both know that the vast majority of those things don't work out, right? And I'm not built to have 9 zeros and 1 50x. This is not what I want to do. I think fundamentals always matter, and it just depends how you define them.
Are there any other sort of prior high flying stocks that haven't been taken out yet that should be, right? I mean, it doesn't seem like the layups are that obvious anymore.
I agree. I mean, Tesla is the biggest layup. I mean, Tesla, which hit 150 this morning. At 150, and I actually put a tweet out about this just shortly before we started. At 150, it's still a $475 billion market cap, right? So to me, that still has, as it wisely said a while ago when I compared it to BMW, from Tesla to get to the value of BMW, that's 90% downside, roughly, from right here. Almost 90% downside. So, but other than that, yeah, I mean, I agree. Like, the Netflixes, I mean, the whatever, they've been taken out and shot. I'm not saying any of them are cheap. That's one of the reasons I'm short SPY, as opposed to, because there's a lot of, and I haven't looked at individually a lot of large cap stocks lately, but last time I did look, a lot of them were still really expensive. Like a lot of boring companies were expensive, right? Like, I don't know, like what's the PE? Hang on one second. On Procter and Gamble has a PE of 26. right? I mean, it might be stuff like that still has to, get shot, so to speak,
Yeah, which is interesting, right? Because it's true. A lot of the in quotes safer, nothing safe, right? And kind of relatively safer stocks are enormously overvalued. Look at the utility sector, individual names there, consumer staples, the things which people would hide out in also now have gotten very overvalued. But it's not like you're going to have the same type of manicness on the way up or down, as you had with Tesla. But it's interesting, right? Because now it's like you can argue the conservative stuff is probably even more overvalued than everything else.
Yeah, and look, I'm not one of these guys calling for the S&P to go back to 666, right, which was the bottom in 2009. I mean, if I take, I don't know exactly what my multiple came out to, but if I take 2880, let's say for the S&P, and right now it's at 3834, okay, so that's down 25% from here. That's meaningful, but from the very peak of this bull market to what I'm saying is seems like fairish value, I think it's around, call it 40% or something. That's completely average for a bear market, right? Peak to trough of 40%. And in fact, in 2000, I mean, forget the NASDAQ, right, which was whatever, 80 or 90% peak to trough, but even the S&P, I think, was around 50% peak to trough in the 2000, the 2003 era. And then in the 07 to 09, the S&P also declined, 50% or in the 50% range. So for me to look at but I think most intelligent people would agree, the biggest asset bubble of all time, and only call for a 40% peak to trough decline in the S&P. And I think that's pretty conservative, I mean, it's funny when I say the biggest asset bubble, and, we all know the stuff I'm talking about. I mean, I assume we all know, big crap like Bitcoin. There's a guy I love following on Twitter. He doesn't tweet that much, but he's a very smart guy, a guy named John Arnold, who is a retired energy hedge fund guy. He's in Texas. And now he's just a full-time philanthropist, but he still tweets about markets every once in a while. And he put out the best tweet I ever saw about this bubble. I think it was like early 2021, where he basically said, and I'm completely paraphrasing, but just the way it said, the Fed has printed so damn much money that people have had to invent entire new categories, and I'm paraphrasing, of nonsense in which to put it, right? And then he listed crypto, NFTs, sneakers. I mean, he went, he went through this list of stuff, and it just so encapsulated the insanity. So coming back to what I said a minute ago, I don't think, obviously there's nothing magical about a percentage decline, but I don't think looking for a 40% peak to trough from that era in the S&P 500 is unreasonable. And, I'm probably being conservative. One could say from that kind of insanity, the S&P should be down 65 or 70%. And maybe it should, but I'm not going to be short as of right now. I'm not going to be short past, what I'm thinking. And a fair question you might want to ask me, so I'll ask myself as well, what's the upside risk? What if you're wrong? What would make the S&P go to 5,000? Well, I don't think there's anything that would make, I don't think there's any meaningful, sustainable upside risk to the stock market until prices are a lot lower. So, if you look at the 1970s, between 1973 and 1975, the PE multiple, I think that's the gap number on the S&P, went from 18 to 8. Okay, why? Well, inflation, right? Inflation and interest rates. And so obviously you put a much lower multiple on earnings. So, and then after that, nominal stock prices started climbing again, right? So, okay, well, the market only sold whatever at 8 times earnings, or maybe it went to 9 times, but we had 10% inflation, so earnings went up 10% every year, whatever the number was. I'm making up, I don't know the specifics. So once, my point is, if you think that we are once again headed for an inflationary environment, well, once PE multiples bottom out, then you want to own stocks because just nominal stock prices will go up as nominal earnings go up, right? Nominal revenue goes up. So, that's why I don't want to overplay my hand on the short side. And I think, I noticed you were tweeting something about a lost decade. I don't think we're going to have a lost decade in nominal terms. I mean, if you look at the 1970s, starting in 75, stocks went up a lot, but it was nominal, right? Inflation adjusted, the returns were lousy. So yeah, we might have real returns that suck for the next decade. But nominally, you don't want to be short. Once PEs have bottomed out, you don't want to be short anything in a high inflation environment because nominally it's going to kill you. I mean, unless you figure out a way, obviously, to hedge the inflation, and that's difficult. So so that's where I'm. Oh, so on upside, so the only thing I see is call it a short-term, meaningful upside risk is if one day we wake up and Putin's dead. Okay, and by the way, I should caveat that with dead and not replaced by some crony who is as crazy or even crazier as he is, right? But if you wake up one day, Putin's dead, and some guy comes in and says, hey, Putin fucked up, we're withdrawing from Ukraine, let us sell you your oil again. Yeah, you're going to have a hell of a rally in stocks. But that's not the reason why Ukraine and Russia is not why I think stocks are eventually heading a lot lower. It's the aftermath of the bubble. So I don't think that will be a sustainable catalyst for the market. But if you said to me, hey, Mark, I just got a tip, Putin just died in the hospital and the market opens in 5 minutes. I mean, assuming it was legal to trade that, I have no idea. I would get long as fuck because, that would kick off a rally. Short of that, I don't see any upside catalyst in stocks before they're considerably lower.
I think that's a good place to end this conversation. Everybody that's curious, please make sure you follow Mark on Twitter, and I will have this again as an edited podcast under that Lead Lag Live banner. Thank you, Mark, for spending the hour here, and we'll be in touch. Thank you.
Thanks. It was a lot of fun. I appreciate the invite. Take care.
Cheers.